Good morning, ladies and gentlemen. Welcome to Dhanush channel. Today I am going to complete the second chapter of Economic Survey 2025. I am going to give a quick recap about what are the major elements in this chapter as far as UPSC is considered. We all know that the second chapter is about monetary developments and financial developments in the country. I have made almost 3 videos covering the so-called a quick recap about the entire economic survey of second chapter. Second thing that I did is I have covered about the banking sector in India, how the banking sector has performed. The third thing that I have discussed is about the capital markets. Subsequently, I have discussed about the so-called the money markets, secondary markets, and then I have discussed about insurance sector, pension sector, cyber security issues, these things, and what is the role of international financial organizations, particularly the GIFT City, and regulators in regulating these markets. These are the things that we have discussed successfully. So now what I am going to continue is, we are going to continue what is important elements from this chapter as far as UPSC is considered. So it is exclusively for UPSC prelims as well as mains. What are the things that we have to take from chapter number 2? With this, chapter 2 will be completed. Subsequently, I will go to third chapter. Here there are certain terms that we can expect in this examination. First one is the cart and the horse. Recently, we have seen one question in some test series. The cart and the horse has been in news. It is regarding to what? Horse is nothing but the Indian economy. Horse is the one which is propelling that economy. So we consider the horse as financial and monetary segments. Our economic survey has considered the horse as the financial segments as well as the investment options that we have. So what is propelling this economy? What is driving the economy? What has to come first in order to propel this? So cart and horse, first of all, let me tell you what is cart and horse. It is an idiom which says that how the things has to be arranged so that we have to execute a plan. So whenever we are executing a plan, if you write down what are the steps that we have to follow, that process is called the horse and the cart. So horse has to come first and the cart will be coming back. So what is the horse for this economic survey as horse for this Indian economy? The horse for this Indian economy is the banking sector, the investment sector, the insurance sector, and the pension sector. These are the horses which the economic survey has defined. And then what is the cart? Indian economy as such. Now where this chariot is moving? This chariot is moving from 2025 to 2047 to the place of the so-called our Viksit Bharat. So in this context, what are the important elements that we have to see? Not more elements, only few elements. Let me start from back. So what are cyber security issues? This can be asked in GS paper 3 as far as internal security is considered. The second thing is role of regulators. This can be asked in GS paper 2 in mains. And when it comes to prelims component, you have some terms like what is financialization, which was discussed in this, and who gives certain indices which are covered here. And then the third one that they can ask in the mains that we can use is what is the profits of the banks, what are CRAR, what are CETs of the banks. And then they can also ask about the so-called what are gross NPAs of the banks in India today, what are net NPAs of the India today. And then we can also think about the insurance penetration, insurance density, what are the pension schemes that we have. So these are certain finer elements that a normal student who is preparing for not only Union Public Service Commission, even for the State Public Service Commission, has to look up and they have to be prepared for these things. So this is what I am going to discuss now. So this is a quick recap. You can consider this as a recap of the entire chapter. At the same time, it can also be considered as the element for preparation for UPSC prelims, right? So those who have not watched my earlier videos, that is completely fine. But this is a quick summary about the so-called what are the things that we have to see in this second chapter. So please allow me to share the screen and then you'll be able to understand exactly what we are defining here and what we are discussing here. So as I said, ladies and gentlemen, this is the chapter. So this is speaking about the cart and the horse. Class number 7 of this survey, horse and cart. And the horse and cart is chapter 2 of economic survey. So let me go for a quick recap. I have taken the entire document. You can download this document from my Telegram channel and the Telegram channel description is given below. in the comment box. Now, the outlook, what is the summary of the entire chapter? I said this chapter is divided into 90 paragraphs. So if you go for this, Indian financial sector has performed decently well, and our financial parameters of the banks have been decently well. And then there has been substantial growth in the credit and deposits of scheduled commercial banks. And India has been one of the fastest growing economies among Z20. Particularly in the insurance segment, it is going to dominate in the next 4 years according to the so-called the reports. Next one is, in the Indian financial sector, the consumer credit in the overall credit has been extended. More people are getting loans. Even in the loans, non-banking financial sector is dominating. Equity-based financing has captivated the popularity compared to the debt market. And then the total number of young population who are entering into the markets has substantially increased. Then this is important. This is what they will fix they will ask the question. What is financialization? Financialization means the dominance of financial markets in shaping policy and macroeconomic outcomes. The dominance of financial markets in shaping the policy and macroeconomic outcomes of the economy. So what exactly is dominating your economy? Today, what is this financialization? In short, remember this. If I have money, rather than keeping in some books, if I am keeping in some stocks, right? This is called financialization. Why I am keeping in stocks? I am keeping in stocks because I thought that the stock prices will rise, then I am going to get more returns. So my thought is to get more returns from stock exchanges rather than keeping that in purchasing some books. If I do purchase some books, if I read them, my knowledge is going to enhance. I can apply that knowledge and I can get more money in this way. This is called real productivity. But if I am keeping money just for rotating this money, if I have 1 lakh rupee, if I give you in form of informal money lending, expecting that I will be getting return. Yes, in form of money you can get, but that is going to substantially hit your real production or real activity. This is what economic survey says. Though the dominance of financial segment compared to the so-called other macroeconomic outcomes is known as financialization. Now, what are the challenges that it may lead to? It may lead to unprecedented levels of public and private debt, and then we can also see over-reliant on this may create inequalities, and then asset market considerations are going to be quietly varied. So all these things are going to hit the economy. So what is important is we have to balance financial savings along with the so-called investment needs, and we should also ensure that there is high amounts of financial literacy. So one term that they can definitely ask is financialization. What is financialization? So moving the money from the productive sector to financial sector is financialization. So up to some extent it is good, but if you are over dependent on financial segments, then that is going to hit the economy to the maximum. This is what the survey is saying. This is the first thing that we have to look. The second thing that we can have a look at is, so whether the growth of financial sector is coming at a cost or not. Yes, obviously financial sector growth, this is called financialization. If you are improving more and more amount of money, increasing more amount of money in the financial segment, it is going to create a cost on the so-called the real productivity. So financial sector and the real economic relationship, if you look at it, so up to a period, financial sector development, if you are developing financial sector up to some extent, it is completely good. But if you are increasing your financial sector furthermore, and if it is catching more and more money, the growth rate is going to fall. And this is what visualized in major economies like US and Japan. So what is this? There should be a trade-off between the money that is going into the financial segment as well as the money that is coming into real productivity. So if you look at this, this is an inverted U curve, and almost all the economies have seen the same thing. So if you are investing little amount in the financial sector, there is substantial growth. But if you are crossing a point, then that is going to create damage for the economy. This is what they have been analyzing, and this is what financial sector development analysis is. Right. So this is what we can remember. This is about financialization, by the way. So that is one thing that we have to remember. And they have given some examples also. Not necessary. Next. So risks pertaining to Indian financial sector. What are the risks? There has been various financial innovations in the country, and this is one good thing, that UPI, and then you have open credit enabled network of RBI, and then T+1 settlement, and then you have ULI, Unified Lending Interface app, which is going to be introduced by Government of India or RBI, and MSME sector financialization. All these things are positives in the Indian economy. Hence, there is some growing reliance on financial industry. However, if you look at the other things, the banking sector as well as the capital requirement gap in the country is increasing, and there are many vulnerabilities that are going to arise due to cyber security risks, these things. So these are the things that we have to focus. All these are pooling the money, but excessive pooling of money by these institutions such as UPI or open credit enabling network or T+1 settlements, this might ease the financialization, but that is going to create some problems. Next, as far as the cyber security aspects, this is one risk that the financial segment can face in the country. So this is important, guys. Here we can expect one mains question: what are the cyber security challenges to Indian financial sector? So cyber threats are like this: distributed denial of services, which means some people who are cyber criminals, they can catch a network and they can deny the services. For example, if they catch hold Yes Bank servers, then that is going to create challenges to the people who are operating in the Yes Bank. So distributed denial of services, and then SMSing, that is sending wrong SMS and asking your PIN numbers like this. Fake and malicious mobile applications pose serious threat to Indian financial network. These are the things. In order to overcome this problem, by the way, in India you have CERT in India, Computer Emergency Response Team, and if you look at how many cases that it has handled in the year 2020, 21 and 22, 11.6 lakhs cases have been handled, 14 lakhs and almost 14 lakhs again in 2022. So if we go by this, 11.6 lakhs substantially increased to 14 lakhs and almost it has been maintained at the same thing. So this shows that Computer Emergency Response Team India is getting more and more amount of cases, which is going to be one of the biggest challenges in the upcoming days. So like this, you have some problems. In order to overcome these problems, and look at this, the Global Financial Stability Report of IMF. This is important. Who gives this stability report? IMF gives this Global Financial Stability Report. So they say that the cyber attacks have resulted in extreme financial losses since 2017, and the losses have been almost increased by 4-fold times. Right. So in the entire world, it has been reached to US $2.5 billion. So according to IMF's Global Financial Stability Report, this report is important. IMF gives Global Financial Stability Report. The total losses is $2.5 billion US, which has increased almost 4 times since 2017. So what are the challenges, or what are the solutions that you have? In India, you have Financial Cyber Security Policy, launched in August 2013. It is a comprehensive collaboration and collective response to cyber security in the country. So the first one is National Cyber Security Policy that we have. And then for coordinating all the regulators in India, you have Financial Sector Development Council, headed by the Finance Minister of the country. Under this, there are all the regulators, be it RBI, be it SEBI, be it PFRDA, IRDAI. So all these are agencies under Financial Sector Development Council, and that is coordinating the so-called the maintenance of financial stability, particularly in the financial sector. Overall cyber security, we have a doctrine known as National Cyber Security Policy. Next, as far as Global Cyber Security Index is considered, India's rank has been substantially improved. This is important. Global Cyber Security Policy is released, and this is going to play a very, very crucial role in the financial sector of the country. So, India's score in this Global Cyber Security Index has been around 98.5 out of 100. This is a very great achievement, and India is the role model for everyone. Now, what does it evaluate? GCI evaluates national efforts on cyber security from 5 angles. One is how far a country is legally prepared. technically prepared, organizationally prepared, capacity building of the country to address these type of challenges, and cooperation that is possible. So legal, technical, organizational, capacity building and cooperation is what they are looking at it. And through this, the Global Cyber Security Index, India has achieved a very good ranking. This is one thing, another important area for UPSC prelims. One is financialization, the second one is this segment. Now RBI is also collaborating with other regulators in order to ensure that there is financial sector stability. So National Cyber Security Policy, you have Financial Stability Development Council, you have regulators like RBI and other regulators which are regulating the financial sector development in the country. Next, we are also looking at the so-called we are looking at some international references in order to develop our financial segment. At the international level, you have one thing called Information Security Management Systems, Information Security Management Systems, NIST Cyber Security Framework, CPMI IOSCO Cyber Guidance for Financial Market Instruments. These are the instruments which are present, or the ways in which you can protect your cyber security or financial institutions from cyber threats. At the international level, you have to remember this: Information Security Management System, Information Security Management System, NIST Cyber Security Framework, CPMI IOSCO Cyber Guidance for Financial Market Infrastructure. So remember these names. These are the things which you have at the global level that India has to adapt, and RBI is trying to recently introduce this. Additionally, if you look at what India has, we have sectoral computer incident response team to provide sector-specific technical support and incidents reporting, loss of some money in cyber security. So this is another thing that we have in India particularly, that is sectoral computer incident response team. Sectoral computer incidents response team, CSIRT. Incident response team, sectoral computer incident response team you have. This is another area where it is providing some collaboration. So overall, India's accession to Tier 1 in GCI 2024 clearly indicates that the nation's enhanced security commitments. So this is a very good indication that the country is performing decently well as far as cyber security is considered, thanks to the so-called Global Cyber Security Index, which has recognized India's commitments towards this. So this is GS paper 3 question, ladies and gentlemen. What are the cyber security challenges? Distributed denial of services, SMSing, fake malicious mobile applications are facing serious challenges to financial systems. To overcome this, in India we have Computer Emergency Response Team, which is tackling more and more cases, somewhere around 11.6 lakh cases, 14 lakh cases and 13.9 lakh cases in 2020, 21 and 22 under Ministry of Home Affairs. They are tackling it. The second thing that we have is at global level, almost 1/5 of all the reported cyber incidents involving financial institutions. So cyber threats have been increasing in financial institutions. Next, according to Global Financial Stability Report of IMF, the total cost of loss due to cyber security or cyber threat is $2.5 billion in the last few years from 2017. In India, you have National Cyber Security Policy 2013, FSDC Cyber Security Index, in which we are considering 5 indicators, and then respective regulators. And at the international standards, there are some global standards that India has to adapt, and then we have to also ensure that the sectoral computer incident response team is also working decently well. So these are the things that we see as far as cyber security aspects is considered. So in GS paper 3 particularly, in the so-called internal security, we can expect a question in this. Coming to the regulators, what is the role that the regulators are playing in the Indian financial segment as such? So if you look at the financial sector regulators, so regulators are the independent regulators, independent autonomous institutions which are at arm's length from the so-called political systems. They do not collaborate with the government, and they do not go for quid pro quo. They are there as checks and balancing mechanisms, and there are different regulators in the country for different segments. Take for example, if you go for utility sector, you have some regulators in the utility. energy regulators, telecom regulators, airport regulators. For competition, you have Competition Commission of India. For higher education, you have Higher Education Management Authority. Next, financial services. For capital markets, you have SEBI. Insurance market, you have IRDA. Pension market, you have PFRDA. Along with banks, you have RBI. So primarily, the financial sector is guarded by these agencies, and in order to coordinate all these agencies, you have Financial Sector Development Council, which is an inter-regulatory coordinating body among these agencies. So this is another important area for prelims that they can focus on. Right. Now they have to play very crucial role, because that is their autonomy which is more important, and they form the so-called they have to make rules, regulations, and they have to ensure that there is autonomy for these institutions. Otherwise, the financial segment can be under turmoil. Right. Institutionalizing regulatory impact assessments in independent regulatory bodies. So you have to also consider how these institutions are functioning. So all these are established through parliament legislations. So as a result, these institutions are responsible to the parliament if they are unable to perform decently well. Right. We have also COG, which mandate includes various audits. COG is another institutional mechanism, and departmental administrating institutions are there, and we have judicial review, which is acting as another regulatory body to be accountable or to make accountable. So all these institutions should go for regulatory impact assessment. How far the regulatory impacts are there due to the excessive regulations? Is it impacting positively, or is it impacting negatively for the economy? And then you have to go for a trade-off between both the things. So what they are saying, we have to go for financial sector legislative reforms. According to this commission, they have said that we have to make regulations as a part of financial code. There has to be a code, and all the regulations should adapt. So what in essence they are speaking, regulators are the people who regulate the trade. Now if there are excessive regulations, this is like going into a command economic model, whereby the private players will be under the clutches of the government. If you let down the guard and make the private sectors to go free without any regulations, then these people will not be effective in handling the system. As a result, there has to be a trade-off on up to what extent I have to go, and I have to ask the regulators to regulate, and where they have to let the guard down. So there should be some liberty. At the same time, there should be some control mechanism, and between them, until what extent, that thin line of difference has to be drawn. And that is what majority of the regulators are not finding it out. Further, the Financial Sector Legislative Commission report also said that there has to be a draft, or there has to be a code on regulating all these financial institutions up to certain extent, beyond which the private sectors has to be given a free hand. So that will act as something, an initiation for the financial sector to perform. Right. So this is what they are saying. Regulation in the financial sector must strike an optimal balance between imperatives of the stability and the goals of fostering innovation, efficiency, and competition. So in India, we have low literacy and many middle class people. As a result, stability is very important. Hence, regulations are important. At the same time, that has to be optimal. Excessive focus on innovation and competition without adequate safeguards can lead to financial instability. That is where Government of India has to focus. So what does this mean? Though the entire chapter is speaking on, or entire economic survey is speaking on something like, I have to make the system to work decently well, and I have to ensure that I have to, what is the theme of this economic survey? Get out of my way. I have to remove all the constraints that the financial sector has, or the private sector has in the country. But if I start removing all the regulations, that might create an intern, a negative impact in the Indian economy. As such, they are asking you to have a trade-off. So you have regulators, their role is important given the considerations of India and the Indian economy as such, and then at the same time, there has to be a trade-off. That is what the challenge that Indian economy will face as far as in ensuring that we are drawing this thin line. So that is how they have given a beautiful analysis. And as I said, they will be asking all this in the so-called GS paper 2, where you have governance issues and governance aspects. So in that way, this is very, very important. But for UPSC prelims, you should know which regulator is what, and Financial Sector Development Council is important from this for prelims. Right. For mains, GS paper 2 governance aspects, it is important. Next. Going to the so-called pensions. Coming to the pensions, I am coming from last, right? So developments in the pension sector, as I have discussed in my last class. So World Economic Forum has highlighted a point that for the first time in the history of the world, globally, the number of people who are aged about 65 has surpassed the total number of children below 5 years of age, which means the total number of aged citizens are increasing in the world. Now, what is the problem here? The more the aged citizens are there, they are dependent on the working age population. As a result, you have to be ready to meet their challenges. If the working population is unable to take care of these senior citizens, then it is the government who has to take care. For that, across the world, you have various pension sector schemes, pension related schemes. Take for India, you have many pension schemes. In that, old age pension schemes are one form of pension schemes. You have widow pensions, you have something like physically disabled or physically challenged persons pensions, right? These are different types of pensions that you have. One type of pension that plays a very crucial role, particularly the old age pension schemes. Now, what IMF says is, IMF is saying that due to this increased number of senior citizens, in the advanced economies, the total pension expenditure is going to be around 1%, and it is going to be around 2.5% in the emerging market economies like India by 2050. So this is the burden that government has to face when we have exceeding amount of senior citizens. So according to, this is another important segment, Mercer CFA Institute, who releases in Global Pension Index. Mercer CFA Institute. This is important segment. Global Pension Index is released by them. So here, according to this, India's overall index value has moderated from 45.9 to 44 in 2024. Right. So on what basis it is going to make mention? Adequacy, sustainability of the pension amount, and integrity. Right. So overall, it is saying that India government, thanks to its various policy mechanisms, India has prepared its peak population to be ready for pensions also. So that is one signature, or that is one understanding that we can make from this pension description. But this is important for prelims, who releases Global Pension Index. Next, coming to the Indian pension system, we have National Pension Scheme, Atal Pension Yojana, NPS Light, and then we have NPS Vatsalya in the country. All this has substantially increased the so-called the pension base in the country, and all these are regulated by Pension Fund Regulatory Development Authority of India. And the data, we are not bothered about this data, but all this has played a significant role in the rise of the pension industry, and the year-on-year industry is grown to 16%. The total investments has grown to 16% in 1 year, due to the significant contributions that is made by the youth of this country for their old age, as well as to the various programs that Government of India has started. Next, in August 2024, this is important, Government of India has started Unified Pension Scheme for government employees, and this is a voluntary scheme. Now, what are the major features of this? The major features of this are, it is a guaranteed pension amount. We all know this. This is a pension scheme that is launched, and a minimum pension to all the people is guaranteed here. So minimum pension for all the people who have worked for 10 years at least in service is rupees 10,000. That is one thing that this government is ensuring under UPS, and it guarantees 50% of the average basic pay of the first 12 months preceding the date of retirement of the guaranteed pension, and for all the people who have served more than 25 years. In case of death of the pensioner, 60% of the pension amount will be offered to the family. Right. So what is this unified payment scheme? Unified pension scheme. Unified pension scheme is an alternative to the existing national pension scheme. So this was launched in Government of India said that on 24th August 2024 they have come out with this. So we have to wait and watch how many people will take this, but this is a voluntary mechanism. Now, whenever I say this segment, that is called the pension segment, particularly from the lens of UPS and NPS, this is another important segment that we have to reason. Unified pension scheme is the new pension scheme, that is a voluntary scheme for the people who are in the pension segment. All the government employees can choose the old pension scheme or new pension scheme according to their voluntary willingness. Now, what is the difference? In the unified pension scheme, which is launched by government based on TV Somanathan panel committee recommendations, first thing is, the government will contribute 18.5% of the total money to the pensioners fund, whereas 10% will be contributed by the employee. So employee 10%, employer 18.5%. 2. At the time of retirement, whatever the salary that the government employee has received, the average salary for the last 12 months before the retirement, out of that 50% will be given as pension. While receiving the pension, if the government employee passes away, the spouse will get 60% of the funds. And if there is a person who has worked in government service for 10 years, minimum pension of 10,000 will be given. And if they have worked up to 25 years, 50% of the basic pay. That is what they said. And this pension amount is adjusted with the CPI industrial workers inflation in order to handle the inflationary pressures on the pensioners. And this is a voluntary scheme based on TV Somanathan panel committee recommendations, and that will be coming into operation from 1st April 2025, that is from the financial year 2026. This is about unified pension scheme, and this government has created as an alternative because majority of the private institutions or government employees are asking that they want a separate pension scheme. This is what we have as far as pensions is considered. So this is what we have about pensions in the country. Going to the insurance market, by the way. So only a few things here. Insurance sector has demonstrated a positive growth of 2.8% at the global level. In India, it grew at 7.7%, the total premium. Insurance penetration has decreased from 4% to 3.7%. Insurance density has moderately increased from $92 to $95. In this, non-life insurance density increased from 22 to 25. Life insurance density decreased, maintained at constant 70. So this is about insurance. The overall insurance penetration in the country is at 3.7%, well below the global average. So the penetration is too low in the country. But we have many schemes that Government of India has started: Jeevan Jyoti Bima Yojana, Pradhan Mantri Fasal Bima Yojana, Pradhan Mantri Jan Arogya Yojana. And according to the Swiss Re Institute, the insurance segment in the country is expected to grow at 11.1%, and it is going to be the fastest growing economy in terms of insurance in the next 5 years between financial year 24 and 25 with an 28 with an expected growth of 11.1%. So this is what the insurance segment that they spoke. Only these things are important as far as insurances is considered. And yesterday I discussed this. Capital markets have been substantially very good in the country. All these are not important. They will not ask how capital markets are functioning in the country. But there is one thing in the capital market, just remember these things. Capital market, you have primary market and secondary market. In the primary market, you have debt market, majorly corporate debt, and you have IPOs and FPOs. In the secondary market, you have equity segment. So one thing is equities are dominating in India compared to the debt segments. Even in debt segments, private placements are dominating than public placements. This is one thing that we have to understand. This is the entire summary of what we have, which is important about primary markets and secondary markets here. And they compared what is the challenges that the Indian stock market can face in the upcoming days. So one is a rise in the investors' participation has been substantially increased. Now if you look at the systematic investment plans, so systematic investment plans are a new types of mechanism for investment in the country, and substantially the total amount of funding that has went to systematic investment plans has increased over a period of time to 13.6 lakh crores. Between 2022 and 2025, within 3 years, the total SIP AUM, right? So it has substantially grown in the country. It has substantially grown in the country. That is what we observe here. Next, they have given what are the challenges that Indian insurance sector is going to face or capital market is going to face. Not important, leave it. Next, GIFT City, ladies and gentlemen. It is an international financial services center authority in India. It is playing a pivotal role in India's Vision 2047. So what is GIFT International Financial Services Authority? It is an unified financial regulator for developing financial mechanisms within India's jurisdiction. So in India, if someone has to come and invest outsiders, in order to regulate them, IFSC is the regulating one. And the IFSC is playing a very crucial role in the regulating of this entire business. And that is what they have spoken about the GIFT City. So this is the thing that they had, and the rest of the things that they spoke is about Indian banking sector, where I have substantially discussed about the banks, how they are performing, and what you have to remember here. Only one thing, how the Indian banks' gross NPAs has decreased to 2.6% of GDP, total loans. Net NPAs has decreased to 0.6% from a highest amount of 11.2%. So apart from that, in the banking sector, how far the so-called, we have seen your insolvency and bankruptcy board has worked. So what is that insolvency and bankruptcy code, how it has functioned, I already discussed in that. These are the major elements that you have in this paper or in this chapter. So this is about chapter 2 entire summary, where I made some 4 videos exclusively for chapter 2. From here I will go to chapter number 3, where we will be discussing about how the prices have been rising in the country, how they are modulated in the country, right? So that I will make in a substantial video. Thanks for joining. I wish you all the best for the upcoming prelims, whoever is preparing for it. If you have any questions on anything that I have to make, you can comment in the description box. I'll be making the videos. Thank you guys. Have a great day. Wish you good luck.